If tariffs are supposed to wreck an economy, why hasn't America's economy collapsed under Trump's trade war? This is the question that has baffled critics, investors, and even everyday consumers. Many predicted a sharp recession the moment tariffs went into effect, yet the U.S. economy has proven surprisingly resilient. Growth continued, unemployment stayed near record lows, and consumer confidence held steady. So, what explains this unexpected strength? And can it really last? Let's dive deep and break it all down. 1. The initial shock never fully materialized. When Trump launched tariffs on steel, aluminum, washing machines, and eventually hundreds of billions of dollars worth of Chinese imports, experts sounded the alarm. Headlines warned of skyrocketing prices, collapsing supply chains, and a global slowdown triggered by America's policies. But in practice, the hit was softer than expected. For one, many companies didn't pass the full cost of tariffs directly onto consumers right away. Some absorbed the added costs themselves, cutting into their profit margins to avoid losing customers. Others stockpiled goods before tariffs took effect or shifted sourcing strategies. This delayed the visible pain and bought the economy time to adjust. 2. The American consumer kept spending. It's often said that the consumer is king in the U.S. economy, and during Trump's tariff era, that was absolutely true. With unemployment hitting near record lows and wages showing some growth, households continued shopping, traveling, and investing in homes. Even if certain goods like electronics or appliances rose in price, the average consumer still had enough confidence and disposable income to keep demand strong. This resilience in consumer spending acted like a shock absorber, preventing the slowdown many economists had warned about. 3. The Federal Reserve stepped in at the right time. Another factor was monetary policy. In 2018 and 2019, as trade tensions escalated, the Federal Reserve made crucial adjustments. By cutting interest rates, they provided businesses and households with cheaper borrowing opportunities. Cheaper credit meant companies could keep investing in equipment, expansion, or payrolls, while consumers could refinance mortgages or take out affordable loans. This infusion of liquidity into the economy offset some of the drag from tariffs, helping to sustain growth. Without the Fed's actions, the story might have been very different. 4. Businesses adapted faster than critics expected. While many feared that tariffs would lead to mass bankruptcies and widespread layoffs, American companies demonstrated remarkable adaptability. Some quickly restructured supply chains, moving production from China to places like Vietnam, Mexico, or India. Others leaned on automation and efficiency upgrades to offset higher costs. Retailers renegotiated contracts, diversified suppliers, or found creative ways to maintain margins. This agility meant that while certain industries, like farming or heavy manufacturing, struggled, the broader business community found ways to survive, and in some cases, even thrive. 5. The hidden costs are real, but less visible. Here's where things get tricky. Just because the economy didn't crash doesn't mean the tariffs came without damage. Farmers, for example, lost access to Chinese markets and required billions in government subsidies to stay afloat. Import-heavy industries saw squeezed margins, with some smaller firms unable to compete. Consumers, too, paid higher prices on a range of goods, from electronics to household items, often without realizing tariffs were the culprit. In other words, the pain was spread out, diluted, and less visible, but it was very real. Instead of a sudden economic collapse, the U.S. experienced a slow drip of costs that are harder to measure in the short term. 6. The bigger question, can it last? While the economy hasn't crashed under tariffs yet, experts caution that long-term trade barriers can slowly drag down growth. If businesses face higher input costs year after year, investment may eventually shrink. If consumers see sustained price increases, spending could weaken. And if global trade partners retaliate with tariffs of their own, American exporters will continue losing market share. The real question isn't whether tariffs had an impact. They did. But whether the U.S. can sustain growth in an environment where trade wars risk becoming the new normal. 7. Politics versus economics. It's also important to recognize that tariffs weren't just an economic tool, they were a political statement. Trump positioned tariffs as a way to rebalance trade and bring jobs back to America. For many of his supporters, the resilience of the economy under tariffs wasn't just about numbers on a chart, it was proof that America could stand strong against global competitors. But politics doesn't always align with long-term economic reality. While short-term gains may have softened the blow, the long-term consequences remain uncertain. So, the US economy didn't collapse under Trump's tariffs, but that doesn't mean it was pain-free. Instead, the impact has been more like a slow burn than a sudden explosion. Whether that slow burn eventually weakens America's economic engine is the question that still hangs in the balance. What do you think? Are tariffs a smart strategy to protect American jobs, or a dangerous gamble that could backfire in the long run? Share your thoughts in the comments. Hit the like button if this breakdown gave you clarity, and don't forget to subscribe to Smart Finance Daily for more in-depth insights into the economy that matter to your future.